Is the market correcting, or are we just reading headline hooks? I'm Keith Walker, and I'm just going to pull the Band-Aid. There's a lot of, let's call it what it is, irresponsibility by realtors, news agencies, and consumers alike in describing the market. Whether that's lack of experience, research, or just emotional reactions, I'm here to share the facts. Let's focus on what's happening right now in our local real estate market and why the fundamentals remain strong. And a reminder, if you like my content, subscribe to my channel or share with someone that may benefit from my videos. Thank you. Let's talk about national headlines versus local reality. Nationally, inventory is rising and interest rates remain elevated, which is shifting some markets into a more buyer-friendly environment. In fact, for the first time in years, there are more sellers than buyers in many areas, which means sellers are starting to compete for buyers, often by lowering prices or offering concessions like closing cost credits or rate buydowns. Now, locally, our story is different. Here, inventory is actually down from 2 months ago at the time of the year when it's usually peaking. Pending sales are up, not down. Our absorption rate is hovering around 42%, with single family homes at 48 and condos and townhomes at 32. That's a balanced, healthy market by any standard. Keep in mind that there are always going to be subsets of properties that perform differently based on type. Bedrooms, locations, schools, etc. And just like everywhere else, a one-bedroom condo without views is most likely not performing like a single-family home in a premium location. So, are prices falling? Well, nationally, there's a high probability that prices year over year could fall slightly on again a national level, with forecasts ranging from a modest dip to flat appreciation. But remember, a price drop of a few percent is not a crash, it's a normal market correction. Correction does not mean crash. It's part of a normal cycle. As a matter of fact, mortgage application rates are up double digits year over year for 9 straight weeks now, a good precursor of buyer activity and increase in demand on the horizon. Now, locally, our average sales prices for June are almost identical to May for both single-family homes and condos and townhomes. Year to date and year over year, prices are actually up. We're not seeing a crash here, just steady, consistent sales and pricing. So why is all of this happening? The shift is being driven by more sellers entering the market, not fewer buyers. In fact, the number of people applying for mortgages in May 2025 is up 20% from last year, showing buyer demand remains strong, like we mentioned before. And the pending sales numbers in Santa Clara County are almost identical year over year for the last 3 years. We're actually still below pre-pandemic levels for the number of sellers. Inventory is rising, but it's moving back towards more normal pre-pandemic levels, not anywhere close to the red flags of 2007 and 2008. Mortgage delinquencies remain low. The national delinquency rate is just above 4%, well below historic crisis levels. Unless we see a dramatic spike in forced sales due to delinquencies, there's no sign of a crash. Now, a quick word on the economy. The S&P 500 has made a V-shaped recovery, up over 5% year to date, and the rally is broadening beyond just big tech. This is boosting consumer confidence and wealth, which often translates into real estate activity. I have some very specific insight and deeper details on this from Jonathan Young, a local financial advisor out of Palo Alto who I've received exceptional input from for years. Also, unemployment in the San Francisco area is just 3.6%, which is low and signals a healthy, resilient job market, especially with continued strength in tech and healthcare. Now, we are seeing a change in the tech sector. There is a realistic fear amongst potential homebuyers as the first months of 25 saw a net loss of 8,700 tech jobs across the Bay Area. This has been a shock to the local economy and consumer confidence. However, demand for roles in AI, cybersecurity, and software engineering remains high, and salaries are among the nation's best. The big picture: consumer sentiment is low, but that's more about uncertainty than fundamentals. Inflation has stabilized, the labor market remains resilient overall, and there's no meaningful spike in mortgage distress. Things are cooling, price appreciation is slowing, but the risk of a crash is very low. We're seeing a normalization, not a meltdown. There is a huge difference. So what does this mean for you? If you're a buyer, this is your window to act. With steady prices and less competition, you can negotiate and find value, especially if you focus on what's actually selling, not just list prices. The list price is just a starting point. The real data is in what's actually selling. But realize there are still many instances of multiple offers on certain properties. If you're a home seller, well-presented, well-priced homes are moving. If you're thinking about selling, you're still in a strong position, especially if you're sitting on low rate financing and high equity. Just know the sales data and trends well before just jumping into the market. There's no reason to panic though. And investors, don't chase or look for quick appreciation. Focus on properties where you can add value or benefit from long-term tax advantages. If you're leveraging stock gains, consider a securities-based line of credit for your down payment rather than selling your holdings outright. Home buyers, an expert tip, you may be able to leverage your stock holdings that way as well. So what's the bottom line? Don't let skepticism or headlines keep you on the sidelines. The data shows a steady, healthy real estate market here in the Bay Area, supported by a strong economy and a resilient job market. If you want to talk strategy or need advice for your specific situation, reach out. I'm Keith Walker, and as always, I'm here to educate and navigate, not speculate or fabricate. Drop your questions and comments below, subscribe for more updates, and I'll see you next time.